Stop refreshing the price chart. Stop screaming into your pillow. And please stop texting your wife that you're going to have to sell the dog to cover a margin call. The dog is safe. You are safe. But the chart you're staring at? That is not safe. That is a crime scene. If you opened your screen this morning and saw nothing but red, if you saw silver smash below $90, gold in a straight nosedive, and felt that punch of fear in your stomach, then I've got bad news. You fell for the trap. You're watching the puppet show while the theater is burning down behind you. Because while the screen is screaming, crash, the data coming out of the vault is screaming, bank run. Ladies and gentlemen, Asian guy here. It's Friday, January 30th, 2026. End of the week. End of the month. And the powers that be decided to throw a party. They invited the price of silver to a red wedding. They dragged it out back and clubbed it like a baby seal, from over $120 to under $90 in less than 24 hours. To the uninitiated, this looks like the end. The bubble popped. Game over. But wipe the tears off the screen and look at the ledger. Look at the delivery notices issued this morning. Because what you'll see defies logic. This was not a sell-off. This was a desperate, failing attempt to stop a nuclear explosion. We need to talk about First Notice Day. If you don't trade futures, here's what that means. This is the day of reckoning. Contract holders face two choices. Choice A, roll the position. Sell February. Buy April. Kick the can down the road and stay in paper fantasy land. Choice B, do nothing. Let the contract expire. And by doing nothing, legally demand physical metal. Historically, the bank smashed the price right before First Notice Day for one reason only. Fear. They want you to roll. They want you to run. They do not want you taking the metal. So they painted the tape red. And then something went very wrong. The longs didn't run. They didn't panic. They stood still. They crossed their arms, looked the banks in the eye, and said, "I don't care about your price. Give me my gold." What followed can only be described as nuclear. The CME data for the February gold contract is now out. On day one alone, 20,484 delivery notices were issued. Let that sink in. Each gold contract represents 100 ounces. That's 2,048,400 ounces of gold. Roughly 63 metric tons. 63 tons of gold changed hands in a single instant. And it happened while the price was collapsing. Ask yourself this. If gold is crashing, why would anyone take delivery of over 2 million ounces? Why catch a falling knife? Because the knife is fake. Because the price is a lie. And because 63 tons of physical gold is worth more than any number printed on a screen. This was a massive vote of no confidence in the paper system. The entities standing for delivery, the whales, the sovereign funds, the central banks, are saying one thing very clearly. We're taking the metal out of the casino. We're going home. Now here's the part they don't want you looking at. Who is on the other side of this trade? Who is coughing up 63 tons of gold in the middle of a physical shortage? Because this is where the fingerprints start to appear. And this is where the story gets very uncomfortable. The largest issuer of delivery notices, the entity dumping the most gold, is none other than J.P. Morgan. The House of Morgan issued 11,959 delivery notices. That means J.P. Morgan just delivered 1.2 million ounces of gold into the market. They are feeding the beast. They are emptying their own vault to satisfy demand. But here's the twist. J.P. Morgan is never on just one side of the trade. They're an octopus. Tentacles everywhere. While their house account was issuing nearly 12,000 notices, another arm of J.P. Morgan, likely a client desk or a separate proprietary book, stopped for 7,995 contracts. In plain English, they gave away 11,000 contracts and took back almost 8,000. Net result? They still lost about 3,000 contracts. So why the churn? Why all the motion on both sides? Because this is a shell game. They're trying to muddy the flow. They want it to look like organic market activity when in reality, it's the same entity sliding gold from the left pocket to the right pocket, all while scrambling to fill physical demands from Deutsche Bank clients and UBS clients who are asking for the real thing. Now look at the rest of the field. Deutsche Bank issued 2,387 notices. UBS issued 2,379. The European banks are being drained. Gold is leaving London. It's leaving Zurich. We don't yet know where it's going, but we know how much. And here's the part you need to understand. On a normal first notice day, you might see 2,000 or 3,000 contracts stand for delivery. To see over 20,000 is not normal. It's a 10 standard deviation event. A black swan. It means the futures market mechanism, the system specifically designed to discourage physical delivery, failed. The paper smash was supposed to work. It was supposed to flush out the longs. It didn't. The buyers absorbed the hit and demanded the metal anyway. That tells you everything. If demand were weak, nobody would stand. If traders were scared, they would sell the contract and walk away. Instead, 2 million ounces stood for delivery while the price collapsed. That is the definition of a broken market. It's like walking into a Ferrari dealership, seeing a sign that says 90% off, and finding a line of billionaires wrapped around the block. The discount isn't a warning. It's a gift. The market is gifting cheap gold to smart money before the reset. But gold was just the warm-up act. The real crime scene is silver. Because while gold saw nuclear deliveries, silver suffered a nuclear price execution. They slammed it from $120 to $90. And just when you thought, fine, I'll buy the dip, something terrifying happened. You couldn't. The buy button disappeared. Dealers went offline. London went dark. This was not a glitch. This was a lockout. We need to talk about the $90 trap. We need to talk about why JM Bullion suddenly went into maintenance at the exact moment of the crash. Because this is the most sophisticated bear trap I've ever seen. If gold was a battlefield with heavy artillery, silver was a special operations raid. And we need to talk about what really happened to silver in the last 24 hours. Because if you're only looking at the chart, you're missing half the story. The other half is what happened when you tried to act on that chart. Silver didn't fall. It was pushed off a cliff. From comfortably above $120 to below $90 in a vertical red line that would make a crypto trader sick. A $30 drop in one day. A 25% haircut. And right on cue, the mainstream media is already writing the obituary. CNBC. Bloomberg. Headlines like, Silver bubble bursts, and retail traders wiped out. They want you to believe this was natural. They want you to believe thousands of investors all woke up this morning and decided, you know what? I hate making money. I think I'll sell my silver for $30 less than it was worth yesterday. That is a lie. This was not a sell-off. This was window dressing, executed with military precision. Look at the calendar. Today is January 30th, the final trading day of the month. That matters. Because bullion banks, JP Morgan, Citi, HSBC, have to report their books to regulators at month end. They have to mark their positions to market. If silver closes the month at $120, those banks are sitting on billions in unrealized losses on their short positions. Capital requirements explode. Risk managers panic. But if they can smash the price to $90, even for one day, even just for the closing bell, something magical happens. The losses vanish. Capital ratios look healthy. Regulators smile and move on. They didn't smash silver because its value changed. They smashed it to paint a pretty picture for the auditors. Now here's the smoking gun. The proof that this wasn't just paper manipulation, but a coordinated physical lockout. When silver hit $90, every rational investor on Earth had the same thought. Buy the dip. If you like silver at $120, you love it at $90. So you grabbed your phone. You opened JM Bullion, APMEX, SD Bullion, and what did you see? Not a buy button. Not a checkout screen. An error message. A spinning wheel. Or in JM Bullion's case, a polite notice saying the site was down for scheduled maintenance. Scheduled maintenance. On a Friday morning? During the most violent silver crash in history. Do you really believe their IT team picked that moment to update server software? Please. I've got a bridge in Brooklyn to sell you. This wasn't maintenance. This was a circuit breaker. The dealers pulled the plug. Why? Because they knew that at $90, demand would be overwhelming. A tsunami of buy orders. They would have sold every ounce of inventory in minutes. And here's the real problem. They couldn't hedge it. With prices collapsing and markets chaotic, they couldn't buy paper fast enough to offset physical sales. So they did the only thing left. They shut the doors, turned off the lights, and hid under the desk. And this wasn't just the US. It went global. Look at the LBMA, the London Bullion Market Association. Reports out of London say their electronic matching systems went offline due to technical difficulties, right as the smash began. That locked out Asian buyers. It locked out the Chinese arbitrage desks we talked about yesterday, the ones ready to buy everything in sight. By killing the connection, Western banks made sure there was no bid to stop the fall. They created a vacuum. They cleared the order book so silver could free fall to $90 without resistance. This is a rigged market. When prices rise, they hike margins to stop you. When prices fall, they shut the website to stop you. Heads they win. Tails you lose. Unless you refuse to play. Because the entire purpose of smashing silver to $90 and locking the doors was to make you do one thing. Sell. They want you scared. They want you desperate. They want you to look at that $90 price, feel the knot in your stomach, and rush to your local coin shop to dump your stack before it gets worse. They are desperate for your physical metal. They smash the paper price to shake the physical. They are praying you are weak hands. But there's a flaw in their plan. A variable they didn't account for. They thought they could shut off liquidity. They thought they could clog the plumbing so no one could buy the dip. But they forgot about the whales. They forgot about private capital that doesn't need a website to buy silver. They forgot about the men who buy entire refineries. And while JM Bullion was down for maintenance, a white knight stepped into the breach. A man with $200 million in dry powder just walked in and cleared the blockage the banks created. We need to talk about David Bateman. We need to talk about the junk silver crisis and the massive floor that was just put under this market. But to understand why the trap failed, you need to understand the plumbing of physical silver. Because not all silver is created equal. And sometimes the pipes get clogged with the wrong kind of metal. While websites were dark and the paper price was collapsing, a silent crisis was unfolding behind the counter of every coin shop in America. A crisis of constitutional silver. Pre-1965 dimes, quarters, half dollars. Junk silver. Normally, this is the lifeblood of the retail market. The most liquid, most recognizable silver on Earth. But in the last 48 hours, it turned toxic. Not because it lost value. Because the refiners stopped buying it. Here's why. The major refineries, the ones melting scrap into shiny new 1,000-ounce bars for the comics, are running at 110% capacity. They're overwhelmed. Industrial demand is screaming. Pure bullion demand is exploding. So they made a decision. No more dirty metal. They told wholesalers, don't send us bags of dimes. It slows down our furnaces. We only want clean, pure industrial scrap. That created a massive bottleneck. Local coin shops were sitting on mountains of 90% silver they had bought from the public. They tried to sell it upstream to free up cash. The wholesalers said no. The refiners wouldn't take it. So the coin shops ran out of cash. And when the local coin shop runs out of cash, the bid disappears. If you walked into a shop yesterday trying to sell silver, you might have been turned away. Not because they didn't want it, because they were illiquid. The plumbing was backed up. The toilet was clogged. This was the moment the banks were waiting for. Price crashing. Websites down. Local shops broke. Panic everywhere. The liquidity trap was working. And then the phone rang. And on the other end wasn't a bank. It wasn't a hedge fund. It was a whale. A private investor named David Bateman. You may not know the name. But in the physical silver world, he just became a legend. He looked at a market drowning in 90% silver no one could move. And he didn't see a problem. He saw the opportunity of a lifetime. Because ask yourself this. If the price collapsed from 120 to 90, someone had to be selling. But more importantly, someone had to be buying. Do you think the Chinese buyers are scared? No. They're laughing. They're looking at the screen and saying, the Americans are insane. They're dumping strategic metal at a discount. Cargo ships are backing up. This crash is a gift. It lets Beijing restock empty vaults, paid for by Western panic. And here's the twist. Normally, after a crash like this, speculators pile in on the short side. Hedge funds smell blood and try to short the market into the ground. But today, the data shows something strange. Very strange. The smart money is not shorting. The hedge funds are looking at the $132 price in China, and they are terrified to bet against it. They know that if this vacuum pulls hard enough, the New York price doesn't drift higher. It explodes to close the gap. So despite the crash, short interest is almost non-existent. We need to talk about the short trap. Because this is where the story gets strange. In a normal market, a 15% crash triggers a feeding frenzy. The sharks smell blood. Hedge funds, algorithms, momentum traders all pile in on the short side. They borrow shares, sell them, and try to ride the price down. And when that happens, something always spikes. The borrow fee. Everyone is fighting for the same shares to short, so the cost to borrow explodes. But today, we're looking at the internal data for SLV, the largest silver ETF on Earth. And it's telling us something that should not be happening during a crash. The smart money is missing. We just checked the prime brokerage data. As of this afternoon, the fee to borrow SLV shares is 0.53%. 0.53. That's not stress. That's free. Rock bottom. And the number of shares available to borrow? Over 10 million. Sitting there. Collecting dust. Nobody wants them. Nobody's borrowing. Nobody's shorting. Do you understand how insane that is? The price just collapsed. A historic move. And yet professional speculators are refusing to bet against silver. Why? Because they're not stupid. The hedge fund managers in Greenwich and Mayfair are staring at the same global map. They see $132 in China. They see $118 in Mumbai. And they see $108 in New York. And they know that shorting silver here is like standing in front of a freight train holding a piece of paper that says, "Stop." The freight train is physical demand from the east. And if you stand in front of it, you don't get rich. You get run over. This tells us exactly who caused the crash. Not the market. Not speculators. A small handful of bullion banks. Likely just 2 or 3 entities. They are the only ones selling. They're dumping proprietary positions, selling contracts they don't have, naked shorting in desperation to cap the price, to protect their balance sheets, to defend the dollar. But they are alone in the trenches. The cavalry isn't coming. The rest of the financial world is standing on the sidelines, eating popcorn, watching the banks dig their own grave. Because the smart money knows this $108 price is a coiled spring. The moment the selling stops, arbitrage wakes up. The moment pressure lifts, price snaps back to $118 or $132 in a heartbeat. And if you're short when that happens, you're finished. This crash is artificial. Painted tape. Designed to scare you, the retail holder, out of your position. They want you to panic. They want you to sell real metal, so they can buy it back to cover their naked shorts. But institutions aren't falling for it. They see 10 million borrowable shares and say, "No thanks. That rail is electrified." And here's the ultimate irony. Even the banks behind this smash know the game is almost over. Publicly, they're slamming the price to $108. Privately, their own strategists are publishing targets that would make a silver bug blush. We need to talk about JP Morgan. We need to talk about the note that just hit the wire from their lead strategist. Because that's where the mask finally comes off. Because while their trading desk is hammering the sell button, their research department is quietly telling clients that gold is going to $8,500. The disconnect is total. This is where the story crosses from market manipulation into institutional schizophrenia. If you want to know what banks really think, not what they're trading today, but what they're positioning for tomorrow, you don't watch the price. You read what they tell their high net worth clients behind closed doors. There is a wall between the trading desk and the research desk. The trading desk is paid to make money today. They smash price, run stops, and harvest retail fear. The research desk is paid to be right eventually. And right now, the biggest bank on earth, the fortress itself, JP Morgan, is showing a full split personality. On one hand, gold is being slammed down $500 in what looks like a naked short attack with all the fingerprints of bullion bank intervention. On the other hand, at the exact same time, a research note just hit the Bloomberg terminal from JP Morgan's lead global strategist, Nikolaos Panagurtsoglou. This isn't a YouTuber. This isn't a doomsday prepper. This is the establishment. And what is he saying? Is he calling for collapse? Is he saying the bubble popped? No. He's calling for gold to surge toward $8,500 per ounce. Let that sink in. The screen says $5,200. The bank says $8,500. That's a 63% upside from here. And his reason has nothing to do with war or mine supply. It comes down to one word: allocation. He points out that private investor allocation to gold has risen to 4.6%. To a normal person, that sounds small. In global finance, it's seismic. Moving from 1% to 4% means hundreds of billions of dollars rotating out of stocks and bonds and into hard assets. And the bank knows this isn't a trade. It's a migration. Pension funds, sovereign wealth funds, family offices. They are losing faith in debt. They fear inflation. They fear currency debasement. And they are quietly turning the dial. Here's the dirty secret. JP Morgan knows gold is going to $8,500. They know $5,200 is absurd. So why smash it today? Why allow this crash? Because they're accumulating. They're running a double game. They use the paper market to crush sentiment, scare you, and force ETF holders to puke shares so the bank can scoop up physical metal at a discount. They shake the tree. And every apple that falls, every contract panic sold by retail today, is being caught by the same institutions forecasting the moonshot. This is classic Wyckoff. A terminal shakeout. They push price below support, trigger stop losses, flush weak hands, and create the liquidity they need to build longs. They aren't shorting because they think gold is worthless. They're shorting to buy time, to keep price suppressed while they load the boat. Because if gold gaps to $5,500 today to match London, they pay more for their own inventory. So they suppress. They accumulate. They wait. And when you see that $8,500 target, understand this. That's not marketing. That's the destination. The crash to $5,200 is just a pit stop. And if you get off the train here, in fear, in panic, believing the headline instead of the balance sheet, someone else is taking your seat. Now, if you let them scare you out of your seat, you're going to be standing on the platform watching the wealth of a generation pull away without you. You have to stop looking at the rig price. You have to look at the world price. You have to look at $132 in China. You have to look at $118 in Mumbai. And you have to understand that $108 in the United States is a temporary hallucination. It's a glitch. And glitches don't fade quietly. They get fixed violently. So let's deliver the final verdict. Let's be very clear about what this decoupling actually means. Because we've just walked through the crime scene of the century. We've examined the fingerprints. We've identified the weapon. And we know who the victim is. The victim is price discovery in the United States. It has been beaten into submission by a coordinated, desperate effort to manufacture a false reality. We are now living in a decoupled world. A world where geography determines wealth. A world where arbitrage no longer functions normally. And today, you are being offered three realities. Reality 1, New York. This is $108 silver. This is $5,200 gold. This is the paper price. A price set by derivatives, high-frequency algorithms, and banks terrified of a currency crisis. It is a price where you cannot get delivery in size. It is a mirage. Reality 2, the world price. London. Mumbai. $118 silver. $5,500 gold. This is fair value. This is where physical metal actually changes hands between rational actors before manipulation intervenes. Reality 3, China. $132 silver. $5,600 gold. This is the hard floor. This is the price of desperation. This is what happens when 1 billion people have demand and no inventory. This price is a black hole, pulling metal out of the West ounce by ounce. And here is the tragedy of today. Millions of Western investors are staring at Reality 1 and making decisions based on it. They see a red candle in New York and they panic. They sell. And who is buying? Reality 3. Every time an American sells SLV shares or physical metal out of fear, a state-backed or arbitrage buyer is picking it up at a discount and shipping it east. You are not just losing money. You are transferring generational wealth. You are selling your insurance to the very people betting against your system. And you're doing it for less than it's worth. That spread, the $300 gap in gold and the $10 gap in silver, is the first crack in the dam. It's the signal that COMEX and the LBMA are losing control. They can smash paper prices. They cannot smash physical demand. If they hold silver at $108, the vaults empty faster. Low prices cure low prices by destroying supply. By making silver cheap in New York, they are guaranteeing there will be no silver left in New York. So here is the final warning. Do not let a red candle in the U.S. session shake you out of a green reality everywhere else. Do not be the mark at the table. If JP Morgan thinks gold is going to $8,500, why would you sell at $5,200? If China is paying $132 for silver, why would you sell at $108? Use the manipulation. If the banks want to put metal on sale, let them subsidize your position. Because this window will not stay open. Eventually, the glitch gets fixed. And when it does, there won't be a warning. Eventually, the arbitrage bots turn back on. Eventually, the metal runs out. And when that happens, the three prices merge. They do not merge at 108. They merge at 132. And then they go higher. This is John. The game is rigged. The spread is real. Don't sell to China.